let's take a look at a covered call, and let's just try to do, I want to go to the search. We're going to do an out of the money covered call position, but with weekly. So I'm going to go in the covered call search, and here's our default screen. This is one of the default searches. We're just looking at the money covered call opportunities, the initial value screen. I'm going to change this to the out of the money covered call positions. But again, this is still looking at monthly options. I want to look at a weekly series. So let's just change this to all expirations. I'll put the days to expiration of 2 to 9. This is so we can see next week's expiration. I'm not worried about today, naturally, or all the time value is gone. I've got to adjust some of these filters here. I got to take the downside protection maybe down to 1%. And we're going to put the percent if assigned for the weekly down to 0.7%. And we're going to lower the option bid price too, because we're not looking at a monthly now. We're looking at 1 week out in time. So let's put that down 15 cents. Everything else should be fine. I don't want earnings between now and expiration. I want the stock in an uptrend. I want to see some good earnings per share growth, relative PE ratio. Let's see what we get here in that search. Almost the same stocks. SeaWorld, Ramaco Resources, Synaptics, Planet Fitness. Both of these two are good. I'm going to take the Planet Fitness position. We're looking at as a stock trading at 64.14. And we're looking at the November 65 strike for standard expiration. 17th of November, 65 strike with an option midpoint. We'll just use that as comparison of 65 cents. Okay, so that's a 1% downside protection I asked for. 2.4% if assigned if the stock moves above that. And roughly it's a 124.1% if assigned, but a 53.2% annualized return if the stock is unchanged, remains at the same price, and our call option expires worthless. And of course, our probability is only 37% that the stock would be above 65 in the next 7 days. Now, before I do anything further, let me save this search real quick. I'm just going to save it, and we're going to call it Weekly Just OTM Search. And I misspelled that, but that's okay. All right, so let's go ahead and save that search. Nothing's going to change. Still got the same Planet Fitness position with the same premium. Now, where I can do my further research and analysis from the More Information button in any strategy, in any search we're using, I want to go to Calculators, and I want to go to Black-Scholes. Of course, the Black-Scholes pricing model shows us what we can expect the option price to be if the stock was trading at any price on any day between now and our expiration date. If we expected a change in volatility, we could adjust that as well. But down below, we have our nice little time decay curve. This is the expected decay of our weekly option over the next 7 days. Now, naturally, 11.10 and 11.11, 11.12, we're going to expect some decay over the weekend if there's no real change in the market. Nothing more escalates in the Middle East or in Ukraine or globally or anything along those lines. Powell doesn't come out and say anything. We have a nice, normal market condition, and the weekend, come Monday, we just open up normally. And on the 12th, we'd expect the option bid price to be at around 53 cents. We sold it at midpoint for around 65. Theoretically, it has it a little higher, but that's about, a 12-cent decline. It's almost 1/5 of the option premium in the first 2 days. 2 days later, on the 14th, we expect it to be about 34 cents. So we've given up about half. We have half the time decay, a profit of roughly maybe 31 or 32 cents. And then, on the last day to expiration, it's getting down to 10 cents or getting down to 0. So in those last 3 days, we lose another 20 cents or 2/3 from the 14th to the end of expiration, from that 31 cents down to 5 cents or 10 cents or lower. Now, why is that important? I'm going to keep the same volatility, keep the same stock price. That, of course, assumes the stock's the same price. We know Planet Fitness isn't going to stay just at 64.14 for the next several days. Let's just change the expiration to 14 days out in time, 11/24. And let's change that and use these numbers. So again, the out of the money call here, highlighted in blue, originally would have been expected to get 112, as we'd expect, based on how options are priced. The option that's 2 weeks out in price, same strike, same stock, isn't going to be 2 times the cost of the near-term weekly. An option that's 30 days out in time is not going to be double the cost of the 2-week. And the option that's 3 months out in time is not going to be 3 times the price of the 1 month out option. Your better annualized return is always shorter term. Assuming everything works out the way you want it to. We know that doesn't happen. Hey, that's why we have the tools to help you with your management, rolling, and adjustments in the portfolio. But here we are at 112, roughly. The call bid would be at 112. The out of the money calls we can see. And on the 14th, it's at 89 cents. Well, that's pretty good. You know, we've dropped down about 23 cents in premium from the 12th to the 14th, or when we got into the 14th. That's 23 cents decay on the 14th compared to the 31 cents of decay or profit we'd expect on the 1 week out, because the rate of decay is faster because we have less days to expiration. On the 17th or on the 16th where it ended, call bid is at 76 cents. So that's going to give us a profit of roughly 46 cents in that case. Where remember on the 16th or the 17th, we were looking at a bid of 10 cents from 65 for the 1 week out option. So that would have been a profit of 55 cents. Where here, with a premium at 76 cents from our initial price of around 112 for the call, down to 76 cents, I'm sorry, it would only be 36 cents of profit compared to 55. We don't start to see the more rapid time decay until we get closer to our expiration date, where we get to the bid of 10 cents. What would 50 cents be from our initial price, where we get to 60 cents? That's happening on the 19th and the 18th. So over the weekend after the 17th expiration. Well, it's close to 68 cents here, but that's really only 54 cents, right? From 112, Kenneth? So that 54 cents is close to the profit on the 17th, but really on the 17th, if we still had the money, we'd have gone to zero. It would make the full 65. Here it's about 68. But on the 16th, the day before, we're only at about a 46, 47 cent profit, as opposed to a 55 cent profit on the 1 week out. Theory and expectation, I understand. Not in direct practice, I understand. But this is what we expect to see. This is what I'd expect to see. This is why I prefer that if I'm making the decision of doing weekly options and then say, oh, well, should I go 2 weeks out and close early? Again, my experience trading, my experience with back testing is that doing that and trying to close at a 50% profit to mimic the profit you were hoping for in the weekly doesn't increase your success rate. Because in that first 5 days, if the stock moved against you, as I mentioned, yes, your 1 week out position would be losing, but so would your 2 week out position. Both are going to be affected. You're not going to get that profit in the first 50% of the trade. You keep your success rate around exactly where you are. You don't increase the success rate by necessarily going double the time and trying to close early. That has never been my experience, never been what I've seen in back testing, whether in credit spreads, covered calls, naked puts, collar positions, standard collar positions, either, Kenneth, using a 30-day out versus a 2 week out. That's not what I've seen.